Hi everyone, Jason Burak. We got a listener request to do a video on some stock picks for gold and silver. Which ones do we think are safe? So obviously, we teach our consulting clients about our paid consulting clients about the gold and silver industry and how to value some of these shares, how to look at reserves, how to tell which ones are undervalued, how to tell which ones have good grades and which ones have good cash flow from their mines and things like that. But I'll just give away a few stock picks here just to show you some of the research that we do. I think the safest gold stock on the planet in terms of investment, long-term investment, is Franco-Nevada. Franco-Nevada has over 38 gold streams and gold royalties that are already generating cash flow. They're diversified all over the globe, but the majority of their larger streams and royalties are in North America, and they don't have any debt, and their costs are fixed, and they have a lot of exploration upside too. So Franco-Nevada is a company that's still making money and generating free cash flow. Yes, it's not as good as it used to be, but it's a very safe gold stock. It's a long-term investment. So if you can get it now at $46 a share on the New York Stock Exchange, that symbol Frank Nancy Vegas, it's a pretty good deal. So I think that's a very solid. I think it's the safest gold stock on the planet. It's not a gold miner though. They're essentially a bank. So they give out loans to gold mining companies or copper mining companies that need capital, or silver mining companies that need capital and want to sell the gold byproduct. And that's how Franco makes a lot of money. Franco did a deal after the 2008 crash. Coeur d'Alene was bringing into production their Palmarejo, their enormous gold and silver Palmarejo mine in Mexico. And this was during the 2008 crash, and Coeur d'Alene, which has been mining gold and silver for many decades, if not I think 100 years. They've been mining silver for a very long time, but they couldn't raise capital during the 2008 crisis. So they went to Franco, and they needed about $80 million to finish off their Palmarejo mine in Mexico, their enormous gold and silver mine. And Franco got at the current value, I think over $1 billion worth of gold on a gold stream for the life of the mine at Palmarejo for only $80 million. So Silver Wheaton and Franco-Nevada do similar types of deals. Franco-Nevada has a very clean balance sheet, no debt. They have a tiny little dividend right now, but as the gold price starts to go higher, it should start growing again. Silver Wheaton is another type of company that's very similar to Franco-Nevada. Silver Wheaton has grown very rapidly. I think the company Nolan Watson actually started Silver Wheaton. He was one of the first employees, and Ian Telfair and some of those other mining legends. Ian Telfair was one of the guys involved in Goldcorp too. So Nolan Watson was the first employee of Silver Wheaton. He was their CFO, youngest CFO. I think before age 30. Silver Wheaton has a bunch of silver streams where they buy silver at a fixed cost between normally $4 to $6 an ounce of silver. The cost is fixed, and everything else, the margin there between whatever the market price of the silver is their profit. So they can generate a lot of free cash flow. Yes, the earnings are going to be down a lot in this environment, but the company is going to survive. So Franco-Nevada and Silver Wheaton are definitely going to survive. Another option here, there's two other good royalty and streaming companies. Royal Gold has good upside too. Royal Gold, their Mount Milligan gold stream is coming online, or is online. So their balance sheet was very levered in terms of debt and other stuff to bring that asset online. And I think they also had a pretty decent exposure to Barrick Gold's Pascua-Lama mine, but that's going to be delayed. But Royal Gold has a good portfolio that's streaming. Their balance sheet is more leveraged than Franco-Nevada or Silver Wheaton, so it's more risky. The other one is Sandstorm Gold, which I really love because Nolan Watson is just I think a great CEO. Yes, Sandstorm Metals and Energy didn't work out, but I've been saying for 2 years that it wasn't going to work out with base metals and coal and natural gas. And doing streams on those. I told those guys in emails that it wasn't a good idea a couple years ago, and finally, it's come to fruition that it wasn't a good idea. But Sandstorm Gold has a really good portfolio still. They do have junior miner exposure, which is why the hedge fund managers and the mainstream Wall Street and Keynesian types, they don't like the counterparty risk to the junior miners. So that's why Sandstorm Gold has been punished. It's gone down more than the gold price has gone down. You have that reverse leverage there. And also, the hedge fund managers are ganging up on this one because the hedge fund managers look you see that Sandstorm Gold has no debt and that they have 14 streams and royalties in the portfolio generating cash flow. They have $54 million a year in annualized free cash flow at $1,200 an ounce gold. And, the normal people will say, oh, that's good. But then the hedge fund, the normal finance people, the value investors say, oh, that's good. But then when the hedge fund people who are looking to make money shorting stocks, they go and look at the counterparty risk. So if some of these gold miners that Sandstorm has deals with, and they're kind of uneasy about that. But, I think gold's very close to bottoming here, and Sandstorm will provide you a lot of leverage when gold does finally make that final bottom and starts to go higher. I think worst case scenario for Sandstorm is maybe the Luna Gold, the Arizona stream is slightly reduced. The stream is slightly reduced. I don't think Luna Gold will go bankrupt. I think Luna Gold will probably get bought by maybe a Yamana Gold or another company that likes to operate. This is just an educated guess. I don't have any inside info or anything. It's just an educated guess on my part. But the Luna Gold Arizona mine is a very high upside mine in Brazil. So that mine, to give you an example of the value that Nolan Watson created, he put in, I think, $20 million into that stream, I think, in 2008 or 2009 to get that mine up and running, and it produced over $200 million in value already. So that's the type of leverage you can get with a fixed gold cost and exploration upside and stuff from the royalty and streaming company, and normally they have pretty clean balance sheets. So I think the royalty and streaming companies are very safe investments for a gold stock. Some other regular gold and silver miners that people should take a look at that we think are survivors, we're just going to give a few. We're not going to give everything away, clearly. Fresnillo is the world's largest primary silver producer. So they're on the London Exchange or over the counter. They have very long life silver mines in Mexico. People should take a look there. It's an interesting, most people in the mining industry don't even cover Fresnillo because they're not listed on an American exchange or a Canadian exchange. But because of that, there's normally going to be value there. But this is a very large silver mining company, and they've also gotten some exposure to gold recently. And I think that's a good one because of their cost structure. Some other ideas in the gold and silver mining space that are miners, not royalty and streaming companies that we think will survive. Yamana Gold is exceptionally well run. They have a fairly clean balance sheet. They didn't drastically overpay for any really stupid acquisitions like Kinross or Barrick did on the way up. Some of these gold mining companies drastically overpaid with either too much equity or debt to try to grow for the sake of growing with their gold mining portfolio. And Yamana Gold, I don't think did that. Yamana Gold was a $20 a share stock in 2012, and their management team is prudent finance guys, but I think they grow very smartly. So they add on a mine and they bring it up, they optimize the mine, and they're very careful with debt, and they don't want to sell too many shares. So Yamana Gold, we're at the chart right now. The chart looks horrible, but I mean most gold charts and silver mining charts look absolutely horrible like this, except for most of the royalty and streaming companies, except for Sandstorm Gold. Sandstorm Gold's chart looks horrible, but I've been buying Sandstorm Gold, more of it here at these levels, because I'm looking 3 to 5 years out, and I'm just going to keep adding quality shares. But Yamana Gold, it could easily in 3 to 5 years, it could be back at $20 a share. It's a very solid company. It should survive. You're getting it at $3.98 right now. I think there's a 1% dividend yield on it. Another company, I'll pull up the chart real quick. Let me pull up the chart real quick. Is First Majestic Silver. Symbol AG. Let me pull up the chart. Sorry about this. It should work. Okay, First Majestic Silver, symbol AG. That's Alice and Greg. This is run by Keith Newmeyer, and First Majestic Silver is another low-cost producer. I remember in 2009 and 2010 buying First Majestic Silver when it was $4 and $5 a share, and within about 18 months, I sold part of my position at $30 a share, and now we're right back to $5 a share, and their silver production has gone from only a couple million ounces, maybe 4 or 5 million ounces, to it's about doubled their silver production. But the market just doesn't believe the sentiment of the market is just so negative now for gold and silver prices. I think Eric Sprott brought up a great point. He's like, well, why is the copper price at $3 a pound and the silver price and the gold price are getting hammered? If it's showing that the industrial metals are not getting hammered like gold, silver, and oil are, and platinum and palladium, something's pretty fishy. So, anyways, though, guys, First Majestic Silver, they have a lot of low-cost silver mines in Mexico. There is country risk in Mexico because Mexico did raise the mining taxes quite a bit. But First Majestic may start diversifying some mine production outside of Mexico. So we'll see how Keith Neumeyer reacts. I think he's one of the best CEOs in the entire industry for operating a mine and understanding when to do acquisitions and things like that. He normally doesn't overpay for acquisitions. I think he's done a lot of prudent ones for those companies. And he's one of those, he's the CEO, if you've seen the video that came out and said, the silver miners should think about forming a cartel to prevent, the paper market manipulation from knocking the price down way below production costs and bankrupting all the silver miners. So I think First Majestic Silver will most likely survive. Maybe they have to sell some more shares here, so equity, or they have to shut down some of their mines or something. If the silver price is so low, Keith Neumeyer's already holding silver back from his production. So I think he's a prudent operator. He's done pretty good in bad silver times before. In 2008, 2009, First Majestic Silver was doing some acquisitions there. Another gold and silver company, will give you one more that I think our listeners should take a look at, is Agnico Eagle. That is AEM on the New York Stock Exchange. That's Alice, Elaine, Mike. And they have very solid production all over the globe. And, that stock has just been absolutely destroyed, too. I mean, this was, that's an ugly chart. I mean, like I said, guys, most of the chart's ugly. Like, most of the regular mainstream hedge fund manager, trend trader, the technical analyst guys, they'll say, these charts are falling knives. I won't buy them. I mean, look at that. That's like a falling knife. That's falling off a cliff right there. That may be the capitulation point there with rising volume and the fall off the cliff right there that I'm looking at with the dot. Yeah, that's rising volume there, and that's the cliff dive. So look, Agnico Eagle, that was in 2011. That was 2010. That was an $80 share price, and now it's down to $23.50. So this company, they have a lot of good mines, good long life, long-term mines. They're fairly low cost. You just got to be careful, though, I would say, for if you're going with the regular gold and silver miners, you really got to understand what their cost structure is. So you got to be able to know the accounting skills and look at a balance sheet, understand how much debt they have on the balance sheet if it's too much. You got to understand what their all-in sustaining costs are. These mining companies tend to, and it's legal right now, it's legal right now, is put out their cash costs. So their cash costs only count moving the metal, mining the metal at the mine and moving the metal. They don't include exploration costs, cost of capital, their cost of debt or equity, or their selling, general, and administrative costs, which are the cost for management and interest expense and all these other things at the headquarters, which any business needs. So the miners have, drastically underreported their costs. This is why you have a company like Tahoe Resources, which is a new emerging primary silver miner in Guatemala. They have a cash cost of $5 an ounce, but their other all-in costs are much lower than another company like Hecla Mining, who says their cash costs are $5 an ounce. Look at their balance sheets and look at how much earnings that each company has. Tahoe Resources is making money in this environment and potentially planning on starting a dividend. And I think their all-in costs are below $13 or $14 an ounce silver all in. And they're still making some money, and they may implement a dividend soon. Whereas Hecla is losing a lot of money producing ounces of silver. So it's just, you got to be really careful here. I would just basically ignore the cash cost, and I would go, if it doesn't say it on their website or in their annual report, I would send an email or call the investor relations and ask them to update their PowerPoint presentation and put in their all-in sustaining costs. That include, replacing ounces and things, replacing their ounces and reserves and things like that, and their cost of capital and their SG&A expenses included. The miners just need to, the gold and silver miners, primary ones, they need to report all-in sustaining costs. They need to just get rid of cash costs because the government see the cash costs in foreign governments like Peru or Mexico sometimes, or Bolivia. And, they see that the cash costs and they think, oh, these companies should still be making a lot of money, but they're not. They're losing money. And then, they raise the taxes and royalties and stuff on them anyway. So that's a basic overview here. Definitely take a look at the royalty and streaming companies first. They're the safest gold and silver companies. They're not actual miners, though. They're more like banks that give out loans, research due diligent loans. They send out, consulting geologists and metallurgists, and they have a whole bunch of finance people that are CFAs with experience in the mining industry for a decade or so, running the numbers, crunching the numbers for mines. I mean, obviously deals can still go bad. I've seen it where the project economics for mines have looked fantastic. The mine gets built, and then, something unforeseen happens. The costs increase rapidly, or there's flooding at the mine, like Colossus Minerals. There was just too much flooding and other things. The project economics for Colossus looked fantastic, and it still didn't work out. And then I've seen where, the numbers they don't look as good on paper for the project economics for like the preliminary economic assessment or the pre-feasibility or the feasibility. And then the mine ends up being really solid and a long life lasting mine. And then, they find a lot more gold at the mine, and the royalty or the stream works really, really good long term for, many years to come, and it has exploration upside, and it pays back its capital very quickly. So look for the royalty and streaming companies depending upon your risk tolerance. If you're very conservative, you're gonna look for Franco-Nevada or Silver Wheaton first. Royal Gold and Sandstorm Gold would be more risky for royalty and streaming companies. And then I outlined a number of gold and silver, primary gold and silver miners that we think they're not making money now, really, unfortunately. I don't think really any, very few, if any, primary gold or silver miners are making money in this environment. But when we get a bottom, and we're going to have a bottom here because we're going to have to go back to supply and demand fundamentals. These guys have to be able to make money in this environment. They can't be subsidized like wind or solar or biofuels. Those industries are subsidized by the government, and that's why those industries, a lot of them can run at losses all the time for as long as the government gives them money. And the mining industry is not. They have to earn their capital back at some point. They have to be able to make money. So Fresnillo on the London Exchange or over the counter, they're the world's largest primary silver miner. I talked about First Majestic Silver, and I talked about Yamana Gold and Agnico Eagle. Thanks again for your time. I hope you enjoyed this video. And if you want extra in-depth analysis, you want to learn how to do your own research on mining stocks, we offer a self-study kit with a whole bunch of research white papers that we've pieced together through the years and found from other experts on how to research mining stocks and value reserves and cash flow and look at balance sheets and things like that. Or we can teach you, in our opinion, how to pick out the best stocks that are going to survive and maybe thrive when the metals prices do turn. But the charts, look really ugly. That does look like a spike bottom there with rising volume. So we should be putting in a bottom here at some point because, as you guys know, I don't think any primary silver miner, except for maybe Tahoe Resources, and they're not a super large one yet, can make money at these prices. First Majestic Silver cannot make money at these prices, and they're one of the lowest cost, most efficient producers in the industry. It says something about the industry. And the primary silver production makes up 25 to 30% of the whole global silver supply. So it's important. There's still a lot of demand for physical silver, and eventually we're going to have a bottom here in the near future because the world still needs silver. The industrial silver demand is still very strong, especially where solar panels increasing, and there's still a lot of investment demand for silver coming out of China and India. And we've seen the mint numbers too. The mint numbers for silver demand, for physical silver, for investment demand is still strong. So thanks again for your time, and good luck out there.